With this video, I want to begin diving into financials of a business plan, of calculating how profitable a business will be in a sophisticated and professional way, but in a simple way for us to get started. And that is with this acronym COGS, COGS, which stands for Cost of Goods Sold. It's a very important measurement to tell how profitable our business will be. And we're going to use the t-shirt business to actually, instead of hand waving and saying, this is a big market, which is not a really professional way. Like, you wouldn't go to an investor and say, the market is big enough, so it's big enough and you should be happy with it. You would never say that to an investor. You have to have a more professional approach. So let's actually begin our first look into business finances. And the formula is the gross profit margin. We're actually going to explore what does the word gross means, what does the word margin means shortly after this video. So don't worry about it yet. So for now, for simplicity's sake, look at it as the profit we're going to make, the general gist of the profit. And trust me, soon we're going to look at the profit in a more sophisticated, detailed way. But for now, because we're just entering this, we're just going to look at it as the profit equals revenue minus cost of goods sold. Cost of goods sold is the cost that the company incurs to create and deliver its solution to customers. So in our case with the t-shirts, the most obvious expense is to print and ship the t-shirt. For every shirt, there is that expense. Of course, different businesses have different expenses, so let's explore that a little bit more. So COGS generally includes these items like the cost of the actual t-shirt materials. Obviously, if you're selling software, there's no materials. But if you're selling physical goods, there are materials like the cotton from which the t-shirts are made, etc. Also, there are some staff costs, but we don't count all the staff salaries. We only count staff salaries involved in manufacturing, the product delivery, customer service, the website costs, only the costs that directly have to do with manufacturing and delivering the product. We don't count marketing or sales. And we don't count things like HR yet. We count them in other calculations, which we'll do a little later in the course. And of course, you might have additional costs in your COGS like website or hosting fees or third-party software that you have to buy, which enables your transactions or something like that, right? Without which you couldn't sell. So these are things you would include in your COGS, no matter what your business is, and then you would subtract that from your revenue. We'll actually look at that shortly. So these are the things that are included. What are some things that are not included? Things like marketing, sales, research and development. Those are not directly having to do with actually creating and manufacturing and delivering the product. You also don't have to calculate overhead costs. Overhead is a accounting term that usually refers to something like costs to operate the actual business, like the rent you have to pay for the building, or utilities like keeping the lights on, or paying for insurance, or paying for equipment, or paying for travel expenses. Those are just overhead costs. And other overhead costs tend to be things like accounting, administration, and HR. So now that we've gotten all that out of the way and we have a sense of what goes into the COGS, let's look at why it's so important and relevant for us. You see, because the COGS usually does not go up proportionally to the rate at which the business grows. Again, the COGS doesn't usually go up proportionally to the rate of the business grows. That's very important, because what it means is that the profit can stay somewhat proportional as the business scales and grows. So let me actually show you how that would look like in a calculation for one sale of a t-shirt. So in our case, we're selling t-shirts for $19.99. So let's calculate our profit from such a sale. The profit equals the sale we make, the $19.99 we get paid, and then we subtract the printing costs of the shirts and the shipping costs, which is around $10. We end up with about $10 profit per t-shirt sold. But if we subtract, of course, the website upkeep and salaries to the employees, which, I don't take salary, right? So there's no salaries. But if there were salaries, we'd have a big, big loss. You see, at a scale of one sale, this is a horribly money-losing business, doesn't make any profit. But that's not what we're after. We're after scale and growth. We need to scale this up. We need a picture of how this will look like when this scales. And that's exactly what COGS is going to show us. Because you see, if we do the same math, but instead of one shirt, sell 1,000 shirts per month, their revenue will become $20,000. And of course, from that $20,000, we have to subtract half because that's going to go into COGS, the costs to print and ship the shirts and the materials of the shirts. And we have to subtract, perhaps at that point, we'll have like one full-time staff member getting paid, let's say $5,000. I just did that for round math. So we subtract some salaries and suddenly we have a $5,000 a month profit, which is not great, but it's not bad. So you see, this COGS calculation gives us a big picture of what the profit ultimately will be like. It's not the ultimate picture. There are many additional things we can add or subtract, but this is one of the foundational calculations. We're taking away the cost of creating our goods and delivering our goods. And of course, this $5,000 is fine, but that's not what we're after necessarily. We're after a certain ultimate scale. So let's actually look at how this will scale as the business grows. So let's say we sell 10,000 shirts per month. That's a revenue of $200,000 minus half of that goes to COGS minus you see $20,000 for staff. We don't have to hire that much more staff, maybe another support person, maybe another marketing person, but not a lot more people. So you see the profit actually stays quite healthy, $80,000 a month. Now that's a really good profit. Imagine that you're the owner of this and you only hire staff and you pay the staff and you collect $80,000 a month. That's actually just under $1 million in profit per year. It's very good. But of course, a business like this that's addressing a big market can grow bigger, right? That's the goal of this. It's brandable. It can become a real thing, a household name. That's the goal of such a business. And because of that, we can look at higher numbers. Well, what if we sell 100,000 shirts per month? That's $2 million in revenue minus $1 million in cost of goods sold minus now we're going to hire way more staff and we're going to invest more. So we're going to spend $50,000 on staff and monthly profit is just under $1 million. That's per month. Even if this is per year, it still would be really good. So at this scale, even if we have higher costs a little bit, we're still doing really, really well. And of course, as we reach our great goals, let's say 500,000 sales per month. This is, of course, if we get into stores, if we truly are a household name. This is like, 15 years out. We're selling 500,000 shirts per month. That's $10 million in revenue. Half of that goes to printing and shipping, minus $1 million goes to marketing, research and development, more staff hires, more of everything. We spend $1 million on all of that, but still we keep $4 million in profit, you see? And we can get these figures because of COGS. That's what COGS gives us. It gives us some initial math we can do. Now, this math is very generic because we can increase sales. We can add fees like shipping fees that are higher than what we incur. So we can have higher profits than the $20 per shirt. And we can also do many other things like negotiate high volume printing deals with printing companies. Because we're such a great client, we send them many, many shirts to print per month. Well, they're going to give us a better deal. So instead of $10, they're going to charge $7 per printed shirt. And suddenly our profits go through the roof. And we can do this pretty early on at like 10,000 sales per month or even 1,000 sales per month. We can probably renegotiate. So there are many, many ways to improve this. And there are also many, many additional costs. But this is one of the foundational calculations, because this immediately stops the hand waving and saying, we're in a big market, and right away you have some figures and some real goals to shoot for. And so with that, in the next videos, let's actually make our calculations more complex.